Alrighty, so as I talked about a couple of days ago, the news continues to flip-flop. The markets are continuing to mostly sell off here. Right now, the S&P is down about, let's see here. This is the S&P 500. We are down a little over 8.5% right now. If you get maybe a 10 to 15% drop we're going to see here in the next couple of months. At least I think that's fairly likely just as we continue to progress through the geopolitical stuff, but also just the economy as a whole. And a big reason for that is that we have this lovely thing called oil that is making some moves. It doesn't look too great. And if we overlay oil on top of the S&P 500, can kind of see here where things have started to really taper off, and oil going up is bad for risk assets as it causes inflation to continue to skyrocket. And oftentimes oil can be the kind of precursor of a recession in the US. So when we see oil spike like this, and I actually have a chart that we can look at, but when you see oil begin to spike, this blue line here, these red lines is a good indication of a business cycle. So this is my favorite macro analysis. Ben Cowan has built this chart. It's a formula including the unemployment rate, the interest rates, the S&P 500, and all divided by M2, which is the money supply. And it creates this chart here that gives us an understanding of business cycles. And then this gray here, the gray boxes across time, those are recessions. And so if you look, oftentimes when this blue line starts to go up, that kind of marks the end of a business cycle. And typically what really the mechanism that brings it down to a new cycle is a recession in the US. And so what we're seeing now is something similar. What you notice at our current situation is we had COVID here, which actually did get a reset as well. But it was not nearly the bubble that we saw in the 2000 period, or if you look back all the way into the early or late 60s, early 70s. But we did have the COVID-induced recession that kind of reset things. And then we went ahead and we printed $6 trillion, created a very large bubble very quickly. And then since then, with the Fed, this is in 2022, they've been doing their best to try to do what they have called the soft landing. And that's what this chart is here, kind of working its way down, is trying to say, okay, let's try to reset things without causing some sort of financial crisis that's going to drop markets like crazy. We've actually been able to somewhat successfully do that. We're making our way down, but if history is any indication, oftentimes what's going to get us all the way down to a reset is a recession. And so with oil spiking the way it has, this is the fastest that oil has spiked really in the history of this chart here, all the way back to the mid-1980s. And so that is not a great sign. And if the geopolitical situation stays sustained for really any period of time into this year, I think the likelihood that we have to deal with a recession is fairly high. Luckily, the unemployment rate is still manageable. It's still pretty low, but it is starting to rise. And oftentimes, when we get to the recession period, there'll be a very quick rise in unemployment. It all happens very quickly. And I think a lot of that comes from the weakness in the stock market. Once that happens and you get a sell-off, companies start tightening the belt, they start laying people off. And then when we get in these situations like right now where there aren't a whole lot of new hires, people aren't looking to hire on new people in different jobs, the workforce gets laid off and they have nowhere to go. And so that mixture kind of creates a nasty snowball. And when you account for the fact that we also are in a record level of consumer debt, those things together add for a little bit of a nasty situation here. Definitely some risk in the economy as we progress through the next couple of years. It's not to say that we are going to go into a recession this year. It could be a few years down the line. We don't know. Maybe it's after AI kind of starts taking over and wiping out the labor force. I'm not sure. But it is definitely something to keep in mind. Now, this chart is the ROI year to date in a midterm year on average. So if you average out all of the midterm years over the course of the last 100 years, you get this chart. And what you can see here is that as we progress through the year, typically we will bottom all the way in October. And so, like I've been talking about, this is sort of the beginning of that sell-off. You get a bounce, and then things will kind of stay choppy and progress until we really work through all of the downside that often can take, a full year to really get through. So the good news is once it's typically gotten to that point, it does find a bottom. You do get a pretty good bounce going into the beginning of the following year. Now that's never a guarantee. This is just an average. There's been many years that have operated very differently than this chart, but it at least gives us some indication of what we should be prepared for. And I think that it makes sense to have some money available as we progress later in the year if we do see some more substantial sell downs and have the ability to buy risk assets at a much better valuation than they currently are. Just wanted to go through what I'm seeing in the markets. Like I said, risk assets are likely going to be pretty dang choppy this year. You just got to weather through it. You got to understand what your allocation is. Rebalancing is important as well. So when the markets sell down, rebalancing across your assets. So that means that you're going to be purchasing some of those assets that are down. Now, what things can we be doing in down markets? One of them, if you're someone who has a beneficiary IRA or you're looking to do Roth conversion, so move money from a traditional IRA into a Roth, down markets are actually a really great time to do that because you're taking a USD valuation of a stock or an asset, and when it's down, you're then able to move more of that stock for less dollars into a different type of vehicle that maybe is better suited for you in the long term. So if your advisor is not talking to you about those things, maybe you should get a second opinion from a different advisor that does. And same thing with, like I had mentioned a couple days ago, if the volatility is something that you're having a hard time stomaching at this point, understand that that probably means that you are overly aggressive for the portfolio that you should have. And it doesn't mean that you should probably sell it right at this point, because oftentimes when we do decide to sell, that's right at the time that you get a nice bounce, and you'll then throw yourself through a whole emotional saga of pain as you then see you made all of the wrong decisions. So I think probably at this point it makes sense to just kind of hold on tight, whatever the allocation you've got. At some point we're probably, even if we do continue lower, we're probably going to get a pretty good bounce in the markets in the next couple of months. And that would be a good time to then maybe take some risk off the table if you are in a place where you're having a pit in your stomach every day looking at the markets or thinking about what's happening. So last thing to remember is just to, when you're seeing these down markets like this, is just to zoom out, because this can look kind of scary. But first of all, we did this literally last year. We saw almost a same kind of drop. This one was actually really pretty dang aggressive. We dropped 21% in the S&P 500 in just a handful of weeks, really. I mean, it was a couple of months, I guess. But really what you want to do is just remember that when you're investing for the long term. We want to zoom way out here and realize that if we do want a good rate of return, we don't have to worry about it. You can just buy the market. And then, so let's say we decided to buy the market in 2011, and then we literally did nothing. And we saw many times the markets went up, and we saw many times the market went down. And if we just did that all the way, even with the sell-off here to today, you still would have made 500% return on your money. So investing is one of the simplest and hardest things to do, which is all you got to do is buy, and then the hardest part is to not do anything. You just got to sit on your hands, let the markets progress, ride the roller coaster. And honestly, I think that a sell-off this year may not be the worst thing. You want markets to go through a healthy progression, and sell-offs are a part of that healthy progression. And if you see things continue to bubble too high, like the 2000s, for example, you will then see a much larger, more aggressive drop when things finally have to come back to equilibrium. So honestly, a 20% sell-off in the market this year would probably be a nice, healthy reset of sentiment. Hopefully, it would get us to a place where inflation is coming back down, long-term interest rates can stabilize finally. People may be able to get those refinances that all your mortgage brokers sold you back in 2022 when you bought a 7% mortgage. And hopefully that'll get things to reset. And then the crazy world that is the AI boom is going to continue to progress. And the next 10 years are likely going to be pretty crazy. And there will be lots of doubt, there will be lots of fear, there will be lots of opportunity, there will be lots of up markets and down markets. And if that sounds like a lot, maybe you should be working with a financial planner that can help walk you through and guide you and be a teammate to you as we progress through all of the craziness in this world. Thanks for watching, and hopefully I'll see you soon.